This is the business Blackbook, where billion-dollar empires are built and collapse. One man fooled the entire Indian stock market, 14 institutional investors, 2 global auditing firms, and the government of India for over 7 years. And when it all came apart, he did it himself, voluntarily, in a letter typed and sent. That is where we begin. Picture this. The year is 2008. India is soaring. The economy is growing at 9%. Software companies are minting billionaires, and sitting at the very top of that golden pyramid is a man named Biraju Ramalinga Raju, chairman, visionary, philanthropist, the face of a company called Satyam Computer Services, one of India's big 4 IT giants, 45,000 employees, 185 clients across 65 countries, and revenues, officially, of over $2 billion. He was celebrated everywhere: business magazines, government banquets, international conferences. The man shook hands with presidents and prime ministers. He accepted awards for corporate governance. He gave speeches about ethics, and every single word was a lie. But here is what makes this story unlike anything else in the history of Indian business. The fraud was not exposed by a whistleblower, not by a regulator, not by an auditor, not by a journalist. It was exposed by Raju himself. And that is the question that will haunt you for the rest of this episode. Why would a man who had hidden $1 billion in fake cash write a letter confessing everything? We will get there. But first, you need to understand what he built. Satyam was not a small operation running shady numbers in a back office. This was a company listed on the New York Stock Exchange, a company audited by PricewaterhouseCoopers, one of the most prestigious accounting firms on the planet, a company that had just won the Golden Peacock Award for excellence in corporate governance. Let that sit for a moment. The company won an award for corporate governance while committing the largest corporate fraud in Indian history. Raju was born in Andhra Pradesh in 1954, the son of a farmer, educated, ambitious. He studied at Harvard Business School. He understood how systems worked, and more importantly, he understood how systems could be gamed. He founded Satyam in 1987. The name itself means truth in Sanskrit. He named a fraud company, Truth. Satyam grew quickly through the 1990s. India's IT boom was exploding. Raju rode that wave masterfully. By the early 2000s, Satyam had become a symbol of what Indian entrepreneurship could achieve on the global stage. The company was listed on the Bombay Stock Exchange, the National Stock Exchange, and the New York Stock Exchange simultaneously. Clients were blue chip. Clients were General Electric, Nestle, Caterpillar, the United States government, These were not naive, small businesses being tricked by a street hustler. These were the largest institutions in the world, choosing Satyam to manage their data. And inside all of that, Raju was quietly building a second reality. On page 1 of the ledger, we find a trick called cash fabrication. Here is how it works. And pay attention, because this is elegant in the most criminal way possible. A company's cash balance is one of the most trusted numbers in financial reporting. Investors look at cash and they think, this is real. You cannot fake physical money sitting in a bank account, except you can if you control the reporting of that money, if you create fake bank statements, if you forge correspondence from banks, if your auditors trust your documents instead of independently verifying with the actual bank. Raju and his team created fictitious bank accounts. They generated fake fixed deposit confirmations. They fabricated interest income that never existed. Month after month, quarter after quarter, they inflated Satyam's cash balance until the fake number had grown to over $1 billion. $1 billion of cash that existed only on paper. But here is where it gets darker. Because if you inflate cash, you also inflate profits. And if you inflate profits, the market rewards you with a higher stock price. And if the stock price is higher, the founders who hold shares become wealthier on paper. But that wealth only stays real as long as the lie stays standing. And Raju knew that. The second entry in the ledger is called inflated headcount. Satyam officially reported 53,000 employees. The actual number was closer to 40,000. 13,000 ghost employees. 13,000 names on payroll, drawing salaries that were simply siphoned off to accounts controlled by Raju and his associates. Think about the scale of that operation for a moment. You need HR systems, payroll systems, fake employee records, bank accounts. Someone has to maintain all of that consistently. For years, without a single internal employee raising an alarm, which tells you something deeply uncomfortable about how organizations can be structured to protect a lie from the inside. The third trick is the one that nearly brought everything down before Raju did it himself. December 2008. Raju makes an announcement. Satyam's board has approved a deal to acquire two companies, Matas Infrastructure and Matas Properties, both controlled by Raju's own sons. The acquisition value, $1.6 billion. And here is the detail that should stop you cold. Matas is Satyam spelled backwards. He was not even hiding it symbolically anymore. The market reacted instantly. Satyam's stock crashed 55% in a single day. Institutional investors were furious. The deal was killed within hours. Raju publicly backed down, calling it a misunderstood decision. But the real reason he wanted that acquisition was to use Satyam's fake cash to buy real assets, to convert fictitious numbers on a balance sheet into actual land and infrastructure that his family would own. He was trying to close the gap between the lie and reality, to make the fake cash disappear into something tangible. And when that plan collapsed publicly, the trap tightened. Because the moment that deal was killed, serious questions were being asked. International investors were demanding answers. The Securities and Exchange Board of India began circling. and Raju knew. The next audit cycle would be the one that broke everything open. So he made a choice. And January 7th, 2009, a Wednesday, Raju sits down and types a letter addressed to the board of directors of Satyam Computer Services. And in that letter, he confesses everything. He writes that the balance sheet carries fictitious cash and bank balances of over 50 billion rupees. He writes that the accrued interest on fictitious loans is over 376 crore rupees. He writes that the profits were inflated every single quarter for years to meet analyst expectations. And then he writes something that has been studied by psychologists, criminologists, and business ethicists ever since. He compares himself to a man riding a tiger. He writes that he was riding a tiger, not knowing how to get off without being eaten. Let that image settle in your mind. He is not claiming innocence. He is not blaming others. He is telling you that the lie became so large that the only way forward was more lie, that the momentum of the fraud had a gravity of its own, that by the time he understood the full danger, stopping was as deadly as continuing. And on that January morning, he decided to stop. The fallout was immediate and catastrophic. Satyam's stock collapsed by 78% within hours of the letter becoming public. $14 billion in market value vanished before the trading day ended. 45,000 employees reported to work that morning, not knowing if they still had jobs. Clients began emergency calls to find alternative technology vendors. Banks froze credit lines. The Indian government, humiliated internationally by the scale of the fraud, moved with unusual speed. Within 72 hours, the board of directors was dissolved and replaced by government nominees. The company law board took over. Emergency stabilization was the priority. But the real story, the one the headlines missed, was what this revealed about the systems that were supposed to prevent exactly this. PricewaterhouseCoopers had been auditing Satyam for years, and during all of those years, their audit process had one fundamental flaw. They were relying on bank confirmation letters provided to them by Satyam itself. They were not independently contacting the banks. They were trusting the documents that the fraudsters handed them. Two partners from PricewaterhouseCoopers India were arrested. The firm was eventually fined $59 million by the Securities and Exchange Commission in the United States and barred temporarily from taking on new clients in India. The question is not just whether the auditors were negligent. The question is whether the entire architecture of corporate auditing had been built on a foundation of assumed trust that was never actually verified. Because Raju did not hack the system, he did not break through walls. He simply gave people documents, and they believed them. Ramalinga Raju was arrested on January 9th, 2009. 2 days after the confession letter. He was charged with criminal breach of trust, cheating, falsification of records, and violations of securities law. Years of legal battles followed. In 2015, a special court convicted him and sentenced him to 7 years in prison. His brother, Rama Raju, who served as managing director, was also convicted. Multiple executives followed. The auditors faced criminal proceedings. The company's chief financial officer cooperated with investigators. And Tech Mahindra, one of India's major IT companies, eventually acquired Satyam in a government-supervised process, rebranding it, trying to rebuild trust with clients who had every reason to walk away forever. Some stayed, some left, and never came back. And the 45,000 employees, most of them ordinary software engineers who had done nothing wrong except work for a man they trusted, spent months in professional uncertainty. Their careers paused while the wreckage was sorted. There is something worth sitting with here, because this is not a story about greed alone. Greed is the simple reading. The deeper reading is about information asymmetry. Raju understood something that most people in markets choose not to confront, that the entire financial system runs on reported numbers, that investors, analysts, auditors, regulators, they all operate downstream of the data, and the data comes from the company itself. That is the fundamental vulnerability at the heart of every public market in the world. He did not exploit a loophole in accounting law. He exploited the gap between what people were supposed to verify and what they actually verified in practice. And that gap turns out to be enormous, because the question that never fully gets answered is this: how does a company win a corporate governance award while committing a fraud at this scale? What were the board members doing? What were the institutional investors asking at quarterly earnings calls? What were the analysts writing in their research reports? The answer is deeply inconvenient. They were all operating on trust. Trust in the numbers. Trust in the auditor. Trust in the chairman who stood at the podium and spoke beautifully about ethics. The Satyam scandal did not just destroy one company. It rewrote the rules of corporate governance in India permanently. The Ministry of Corporate Affairs overhauled compliance requirements. Audit independence rules were strengthened. The Securities and Exchange Board of India was given expanded powers. Mandatory rotation of auditors was eventually introduced to break the kind of long-standing relationship that allowed PricewaterhouseCoopers to grow comfortable and careless. Satyam became the case study taught in every Indian business school. The reason every listed company now faces stricter independent verification of cash balances. The reason auditors are legally required to directly confirm figures with banks rather than accepting company-provided documents. One man's confession rewrote the governance architecture of the world's largest democracy. But here is the final thought I want to leave you with. Raju did not run. He did not flee to another country. He did not transfer assets to offshore accounts in the final hours. He wrote a letter. He confessed. He handed himself to history. Was it guilt? Was it the mathematical certainty that the next audit cycle would expose him anyway? Was it exhaustion from riding the tiger for 7 years? Was it all three? We do not know. And that is what makes Ramalinga Raju different from most fraudsters in this Blackbook. He is not a simple villain. He is a complicated man who built something real, inflated it into something fake, rode the lie until it consumed him, and then, in one inexplicable moment of clarity, stopped. The tiger ate him anyway, but at least he chose when to fall. $1 billion in fictional cash, 13,000 ghost employees, 7 years of deception, and one letter that changed everything. The name of the company was Satyam. It means truth, and with that, the Blackbook closes. Subscribe, and we will open the next page soon.